You're watching the Daily Market Comment by Mario Sechikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. The world's reserve currency absorbed some damage last week in the aftermath of the latest U.S. employment report. Nonfarm payrolls clocked in at 209,000 in June, disappointing traders who were likely positioned for a stronger number. Nonetheless, the rest of the report was solid, with a decline in the unemployment rate and stronger than expected wage growth, pointing to a labor market that is still booming. It is therefore difficult to square the healthy jobs numbers with a sharp negative reaction in the dollar, which doesn't seem entirely justified and may have been the result of one-sided positioning heading into the event. This week, the main event will be the U.S. inflation report that's slated for release on Wednesday. Capitalizing the most on the dollar's troubles was the yen. A wave of profit-taking pushed dollar-yen much lower, with the move receiving some extra fuel from a jump in Japanese yields, which are quickly approaching the Bank of Japan's yield ceiling. Gold was another winner, taking full advantage of the pullback in the dollar. However, the advance was rejected near the $1,935 region, keeping gold trapped in a well-defined range. Looking ahead, the main threat for gold is the sharp spike in real yields. The real U.S. 10-year yield is currently near its highest level since 2009, which makes non-yielding assets like bullion less appealing. While gold has been quite resilient so far, it might be hard to resist the gravity exerted by bond markets for much longer, especially if real yields break to new cycle highs. Equity markets have started to feel the heat of rising yields too. Futures point to some minor losses when Wall Street reopens on Monday, extending last week's retreat. Of course, this pullback is merely a blip on the charts following the stunning rally this year. A tsunami of liquidity after the banking episode in March, coupled with hopes that a recession can be avoided, and a suppression of volatility have been the main drivers behind this rally. That said, the melt-up in stock markets has taken place despite rising yields and stagnant earnings growth, which means valuations have gone through the roof. With liquidity flows now drying up and yields racing higher, this market seems vulnerable to a correction, depending also on the quality of the upcoming earnings season. Thank you for watching the Daily Market Comment at XM.com. Have a great week.